So this chapter involves chapter 3, where we're going to spend the chapter discussing ethics as it relates to CPA firms. I'm going to start with an example. A recently hired political figures decided to start a charity for a popular cause. Appropriate clearances were obtained and a board created of friends and supporters. The board then hired a CPA to do the audit as required by law. The CPA was surprised to see how much of the money raised was being absorbed by expenses and how little was going for the announced purpose of the charity. Large salaries were being paid to the officers, who also received generous expense allowances. There was a large office staff, and the costs of publicity seemed more than ordinary that would be expected. All expenses were appropriately approved, they were supported and documented. By artful allocation of cost and the use of broad general classifications for expenses, the circumstances were not obvious to an uninformed reading of the financial statements. The CPA told management that he felt that more detailed explanations and informative classifications would be needed for adequate disclosure. Management refused and correctly stated that they were not breaking any law by the proposed presentation. When the CPA insisted, he was fired. His report to the board, carefully explaining the reasons for his departure, was accepted without comment. Another CPA firm, who felt less strongly about the representation, was hired to do the audit and issued an unmodified opinion. The first CPA remained troubled, however, that this charity was free to continue to raise money from unsuspecting donors. The rule of confidentiality left him no alternative, he believed, but to remain silent about what he knew. Here is a situation of a potential issue, and this is where ethics become involved. So let's look at some of the steps we're going to use when faced with an ethical dilemma. First, we need to identify what the problem is. From there, we need to look at various outcomes or courses of action, and then what constraints there may be related to coming up with a decision, and then look at what effects that course of action may cause. And then based on that, we should select the best course of action. Ethics is not just about rules, it's about doing the right thing. So why do we have such a need for ethics in the CPA profession? It's important to remember that as CPAs that are in the practice of providing an opinion for financial statements, we are serving the public as a whole. We're serving investors. We're serving banks. We're serving the various agencies that may utilize those financial statements. So we are truly a representative of the public at large. And as a result of the auditing world and the CPA experience, the privilege of being able to be licensed as a CPA, there is so much information that we need to know, and we have guidelines in order to understand the required rules and expectations. And so we need to make sure that we conduct all of our work with a strong level of doing the right thing. We've got standards that are required just for purposes of education. In this day and age, to even receive a CPA, you have such a vast amount of education you're required. And then also, experience is needed in order to perform various functions. Ultimately, the confidence in the public for our practice has eroded significantly just due to all of the poor actions of CPAs over the past decade, and we need to restore the public confidence and have credibility in our line of work. So we've got a code of ethics, a manner in which we need to conduct ourselves professionally. In this code, we've got the principles and we also have the rules. Now, many times students focus on just the rules, but we need to understand why these rules are in place, the overriding principles associated with conducting ourselves in an upright manner. So when we look at the professional ethics, as you see in this triangle, we have the principles. After those principles, we will have rules, which basically help govern our performance. After those rules, there's interpretations that help us understand those rules we should follow. And then we've got a list of ethic rulings that provide additional guidance for our codes of professional conduct. So the principles are broken down into a couple areas: our responsibilities, the public interest, integrity, objectivity, independence, then due care, and lastly, the scope and nature of services. So related to the AICPA code, the various rules are outlined here on this slide, and they show the subject matter for each of the rules. When we talk about independence, and again, this is related to financial statement audits, we need to have independence in various facets. Independence of mind, which means we truly need to be independent from the circumstances involving that client that we are engaged with. So we need to be independent in a true attitude, but that's just not enough. In appearance, we need to be independent. Both are required in this guideline. It relates to independence, when there is a threat that arises related to lack of independence or making sure that one is in fact independent, we can go directly to the code to address this potential issue. If the code doesn't address that specific issue, then it's up to the auditor to see whether there are enough protective means that are available that will provide a safety net to eliminate any threat related to independence. Would a reasonable person, aware of all those relevant facts, conclude that an unacceptable risk of non-independence exists? If a reasonable person would believe that there is independence lacking, one should remove themselves. Here's an example. When we relate to various financial aspects regarding independence, does the CPA have a financial interest in the client? Do they own stock? Is there potential litigation involving the client and the CPA firm? Then independence would be impaired. And then, is there pressure from the client to reduce any audit procedures? We would call that undue influence. If, in fact, there is pressure, then independence is impaired. Independence also relates to family and relatives. If a spouse holds a key position with a client, you can be guaranteed independence would be impaired. And then as we look to various other types of services that may be provided, are there consulting services that possibly relate to the audit? Then independence may be repaired. Does the CPA promote client securities as part of an initial IPO? Well, in that case, the CPA firm is acting as an advocate to that client, and there may be some independence issues. Does the CPA firm provide any type of management for that client? Once again, independence would probably be impaired. So what do we do to avoid these issues? Well, we have various what we call safeguards implemented. We've got various types of education requirements for CPAs. We also have an oversight board to provide us with additional safety. And CPA firms are required to practice independence by having these safeguards in place at their specific firms. So as you see here, if there's a threat, if you think a normal individual could consider something amiss, what is written in the code of conduct that would address this? Then, if it addresses it, you follow the code. If the code doesn't specifically address it, then you go to the next step. Is it reasonable to expect that the threat could compromise professional judgment? If it could compromise your professional judgment, then you go down to, do safeguards eliminate or mitigate the threat? If they do mitigate that threat, then you are not impaired with independence. But if either the threat could compromise your professional judgment, or if those safeguards do not sufficiently mitigate that threat, your independence would be impaired. Excuse me, I said that wrong. If the safeguards don't eliminate, then your independence would be impaired. If it's reasonable to expect that the threat would not compromise your professional judgment, I apologize for that, your independence would not be impaired. Who is required to adhere to these standards? Well, all covered members must adhere to these standards. Covered members would include even staff, an individual who could influence this auditing engagement, partners in the office, partners or managers that provide certain amounts of non-attest services to the client need to also be covered here, and the public accounting firm as a whole. In addition to just the firm, the employee benefit plan of the firm. And then from there, any entity that could be associated with the firm. So, as you see here with the various sections, A has a direct or material indirect financial interest, loan, or joint business investment, trustee or administrator of a state or trust that has such interest. This would apply to all covered members. And then if the section related to owning 5% or more of a client's outstanding equity or ownership interest, that would involve the staff. And then simultaneously associated with the client as director, officer, employee, Again, that would apply to the entire staff also. So, what is a direct interest? What is an indirect interest? From a direct interest, if there is an investment in the client owning any stock or providing a loan, then there is no independence in that situation. As far as an indirect financial interest, if there's an investment in a mutual fund, which in turn owns a capital stock of the client, and it's immaterial in nature, then you're okay. Independence would not be impaired in that situation. As we look here, this provides us with additional information related to impaired independence. If related to the partners or professional staff, has a direct or material indirect financial interest, loan, or joint business investment, are served as trustee or administrator of a estate or trust that has direct or material indirect interest. If we're dealing with the audit function, the firm would not be independent. And then as you look to the office providing that engagement, in both as far as employees, the firm could do that, but the partners couldn't. Again, when we look at B and C as it relates to 5% of the client's equity or an officer or employee, the firm would not be independent in that case. Okay, so we go on to the next slide, and it deals with immediate family members, dependents, and spouses. Now this is a new one, spouse equivalent, which would be a domestic partner. Immediate family members are under the same restrictions as the accountant would be. If a family member violates a rule, interpretation, or ruling that applies to the accountant, then the accountant would not be independent. Exceptions to this rule: the accountant and the firm are independent when a family member is employed by a client in other than just a key position, and certain circumstances in which the immediate family member may participate in a benefit plan related to the client. As it relates to close relatives, those outside that initial family unit, but parents, siblings, or non-dependent children, the partner or the accountant and the firm would be impaired if that close relative is in a key position, or if there's a material financial interest from one of the close relatives of which the accountant has knowledge. So be aware of the guidelines regarding independence. Now, when we're dealing with consulting services, as it relates to public companies, Sarbanes-Oxley has now prohibited various services of the CPA firm. This happened as a result of the Enron case, where Enron and Arthur Andersen had various types of engagements and a lot of other various capacities apart from the audit. They received over $1 million a week in just consulting services. So their independence truly was impaired. As a result of that, SOX has come out with various types of services that the CPA firm cannot provide to a public company. Bookkeeping, financial systems, appraisal or valuation services or actuarial services, any type of internal audit outsourcing, and any type of management or HR services, along with investment services and legal services. In addition, certain types of tax services are prohibited for the CPA to engage in with the company that is traded on the exchanges. Next, we're going to go to Rule 102 as it relates to having integrity and having objectivity. We need to have integrity and objectivity for all of our services. And then from there, it talks about violations of this rule. So violations may be makes or permits or directs others to make material incorrect entries into the financial statements of a client, or fails to correct the financial statements that are materially false or misleading. And in addition, it would sign or permits or directs another to sign a document that shows materially false and misleading. As you see here, materiality is the key that it does impair objectivity. The general standards relate to professional competence and due professional care. Then we'll talk about the planning and supervision of an audit and what sufficient relevant data needs to be collected. As you see here, the body that issues these standards is shown on the left-hand side, and the various standards are shown on the right-hand side. We're not going to spend much time getting involved in who issues the various standards, but you can find it if need be. Primarily, GAAP will be the standards that we need to adhere to. As it relates to the next rule, confidential client information. CPAs shall not disclose any confidential client information only unless one has consent of the client. The auditors cannot directly disclose any illegal acts by the client unless they have a legal duty in which to do so. Our communication is confidential, but it's not privileged as it relates to the clients. Now we talk about various contingent fees. Allowable contingent fees are allowed as long as a CPA does not provide an audit or review of financial statements, does not provide a compilation of financial statements that may be used by another party, and does not provide an examination of prospective financial information. No, contingent fees are never allowed in preparing tax returns or amended tax returns. Now, Rule 501, records. We are allowed to retain our own work papers, but client records are the clients, and we are not allowed to retain that information. Client prepared records must be returned to the client. Client records prepared by the CPA can be provided to the client. However, whenever a CPA prepares information, they may be withheld from the client if the fees that are due them have not been paid. In that case, you can withhold records you prepare, but client records, no matter what, must be returned. Supporting records such as adjusting entries should be provided, but can be withheld again if the fees have been not paid. And any working papers of the CPAs are the CPA's property and do not need to be given to the client. Then we have rules on advertising. As you can see, they can, a CPA firm may advertise as long as it is not misleading. Commissions must be disclosed. And as it relates to CPAs practicing in various types of entities, a CPA firm can use any type of legal business form. Again, it cannot be false or misleading. So here, this slide just shows the various public companies that will be audited and the CPA firm related to practice structures. So, related to now internal auditors, the internal auditors should apply these principles. Integrity meaning for an internal auditor that there's trust and there is an upright behavior. And as it says here, the integrity of internal auditors establishes trust and thus provides the basis for reliance on their judgments. And then with objectivity, internal auditors exhibit the highest level of professional objectivity in gathering, evaluating, and communicating information about the activity or process being examined. Internal auditors make a balanced assessment of all the relevant circumstances and are not unduly influenced by their own interests or by others in forming judgments. And then as it relates to confidentiality, internal auditors respect the value and ownership of information they receive, and they do not disclose information without appropriate authority, unless, of course, there is a legality reason in which to do so. Internal auditors also need to have competency, which means the knowledge, the skills, and the experience they need to have in order to perform those services. So, as you see here, rules of conduct for internal auditors. They need to conduct their work with honesty, diligence, responsibility, observing the laws, providing the disclosures as needed, not knowingly being a party to any illegal activity or acts that would be discreditable to the profession, and continue to observe the ethical objectives of the organization. Objectivity, internal auditors shouldn't be privy or party to any activity that would impair their unbiased assessment. They shouldn't accept anything that would impair or even be presumed to impair their judgment, and are required to disclose any material facts that are known to them. Confidentiality with internal auditors. Don't utilize and use any information that's been given to you as a result of your professional role, and definitely don't use it for any type of personal gain. Again, as far as competency, they need to have the knowledge and the skills and experience in which to even perform these tasks at hand, and will continue to improve their proficiency and the effectiveness and quality of their services. So that pretty much covers it for Chapter 3, and you can look for the lecture for the next chapter.